Welcome back to the Deep Dive. It is Monday, January 12th, 2026. And, if you just glance at the energy markets today, you might think everything's, pretty stable.
It looks calm on the surface, doesn't it? You see oil prices holding steady, supply seems high.
Exactly.
Mm-hmm.
But we're here today because that calm is really just a financial illusion. We're going to be cracking open the barrel, specifically the $63 barrel.
Uh-huh.
Because that price point is actively creating what our sources are calling sovereign fiscal stress for, dozens of countries. This isn't just about the oil market. It's about the solvency of entire nations.
That's the key distinction, right? We have to look past the immediate spot price. Today, Brent is hovering around 63.22, and WTI is struggling at 58.98.
Yeah.
The real story, the tension, what we call the structural dissonance, is in comparing two very different numbers.
Okay.
First, there's the break-even upstream. That's simply the price a company needs to, profitably get a barrel of oil out of the ground. It's purely operational.
Geology and tech.
Exactly. But second, and this is the one that's breaking world budgets, is the break-in fiscal. That's the price a government needs oil to sell for just to balance its entire national budget.
To pay for everything.
Everything. Social contracts, infrastructure, all of it. And the gap between those two numbers has become an absolute chasm.
Okay, so let's unpack this. Our mission today is to figure out why the world has entered this phase of sovereign fiscal stress. Who's making bank when oil is this cheap, and which countries are basically draining their savings just to keep the lights on?
Well, the fact that Brent is sitting right at $63 is not an accident. It reflects some really deep structural forces. If you look at the forecasts, Fitch already called for a $63 average for 2026.
But this was expected.
It was, and firms like Goldman Sachs are even warning that without some major geopolitical event, we could easily see prices slide further, maybe back toward 50.
And the reason for that downward pressure, based on the research we pulled, it really boils down to two enormous forces that OPEC Plus just can't seem to counter. The first one we're calling the China factor.
The China factor is, the end of infinite demand. For 20 years, China's appetite for oil just kept growing, and it basically set a higher and higher floor for the global price.
Right.
Now, that demand has hit a very visible plateau, and this isn't just a cycle, it's structural. We're seeing this massive, incredibly swift penetration of new energy vehicles, NEVs.
So electric cars, basically.
Exactly. And they're displacing huge volumes of gasoline and diesel in what was the world's biggest energy market.
So China's still buying, but differently. It's more opportunistic now, right? They buy when prices dip to fill their strategic reserves.
Precisely. They've become a soft floor that prevents a total market collapse, but they are absolutely not the engine for explosive growth anymore.
And what's the second big force?
The second force is what we call the Atlantic flood. This is just a relentless, low-cost wave of supply coming from outside the OPEC Plus alliance.
So we're talking about U.S. shale Canada.
Yes, them. But the crucial new players are the deep offshore titans, specifically Guyana and Brazil.
What makes their geology so transformative? Why can they just keep pumping no matter what the price is?
It's world-class geology meets modern technology. These are giant, relatively shallow water discoveries like in Guyana's Stabroek Block. It just means the cost per barrel is incredibly low once the initial infrastructure is in.
So their barrels just flow no matter what OPEC Plus decides to do.
They just flow, and they've been incredibly effective at capturing all the market share that OPEC Plus has been giving up with their production cuts.
Okay, so let's pivot to those winners. The producers who are absolutely thriving in this $63 market. When you look at their upstream break-evens, the numbers are almost unbelievable, especially in Latin America.
The divergence there is just staggering. You take the ExxonMobil consortium in Guyana, their average upstream break-in for their big fields is a stunning $30 a barrel.
$30, that's it. So with Brent at 63, they're making a profit margin of over 100% on every single barrel.
100%. That kind of margin means their production is completely insensitive to these price drops. It's just pure capital-efficient aggression.
And Brazil is in a similar boat.
Right there with them. Petrobras, with its pre-salt fields, has an all-in break-even around $35 a barrel. They're just rolling out new production units, taking market share while everyone else is hurting.
And we should probably mention Argentina's Vaca Muerta shale. The best wells there are breaking even around $36 a barrel. So they're a real competitor, too.
Absolutely. So on one side, you have these hyper-efficient producers making incredible wealth at $63, and on the other, you have petrostates trapped by their own spending, and that's where we enter what we call the fiscal death zone.
The fiscal death zone. I like that. That's a perfect way to frame it. So that's the $60 to $80 price range where a barrel is profitable for a company, but it's a disaster for a government that depends on that oil money.
Exactly. Just look at the Middle East. Geologically, it's the cheapest oil in the world. I mean, Saudi Aramco's operative cost is often under $10 a barrel.
But that's not the number that matters for their budget.
Not at all. Financially, they need exponentially higher prices to fund their countries. Saudi Arabia is the prime example, right? With its huge Vision 2030 plan.
That's right, funding these massive gigaprojects like NEOM and paying for a huge civil service.
So while the extraction cost is tiny, the real fiscal break-in, once you add all that state spending in, is dangerously high. Analysts put it somewhere in the $94 to $96 per barrel range.
$94. So let's do the math. If Brent is at 63, that means Saudi Arabia is running a deficit of $15 to $30 on every single barrel they export.
It's a huge structural hole.
What does that force them to do?
Well, it's a tough choice. Either you issue more sovereign debt, which we're already expecting to see in the first quarter of 2026, or you risk slowing down those critical diversification projects.
So the whole OPEC plus strategy of cutting production, it's kind of backfiring on them.
It's looking increasingly perverse, yes. They cut volume, but the price hasn't risen enough to meet their fiscal needs, so their overall deficit just gets worse.
Who's feeling the most extreme pressure from this?
The most critical case is Bahrain. Their estimated fiscal break-even is over $127 a barrel. At 63, their economy is just, well, it's fundamentally unsustainable without help from their neighbors.
But not everyone in the Gulf is in trouble.
Not at all. The UAE is a great example of diversification. Their break-even is around $56 to $60. So at 63, they're basically balanced, maybe even have a small surplus.
And Qatar.
Qatar is the most resilient. Their dominance in liquefied natural gas, or LNG, gives them the lowest break-even in the region, only about $45 to $48 a barrel. They are very comfortable right now.
That's an incredible divergence. Okay, let's shift to Eurasia. Russia is a unique case because its economy is completely shaped by the war.
Absolutely. Trying to analyze Russia's budget is tough. It's so obscured by sanctions and the G7 price cap. Officially, their budget assumes a price of $60 a barrel for their oil. So on paper, 63 should be fine.
But paper isn't reality.
Not even close. The Urals crude that Russia actually sells trades at a huge discount to Brent. They have to use this shadow fleet of tankers and bribe buyers to take it.
So what's the real price they're getting?
The effective price for their exports is somewhere in the $45 to $50 range. Devastatingly low. That's already way below their official budget assumption.
And on top of that, you have the cost of the war.
Exactly. Independent economists estimate that to cover all their military and security spending, their real break-even is much higher, probably between $75 and $80 a barrel.
So they're getting a low price and have incredibly high costs.
And you can see the stress. Their oil and gas revenues were already down 34% year on year in late 2025. It's a serious squeeze.
And before we move on, just a quick note for all of you listening. If you like what you're hearing today and want to support content like this, we'd love it if you'd subscribe to the channel and leave a comment. There's also a link to PayPal in the description. Any contribution, even the price of a coffee, really helps us continue these deep dives. So thank you for your support.
All right, so moving to North America. The issue here isn't a government budget, it's corporate margins and future investment. Let's look at U.S. shale, where WTI is stuck just under $59.
That price, $58.98, that's a critical number for U.S. production, isn't it? Reports from the Dallas Fed show that the average new well in the Permian Basin needs WTI to be between $60 and $65 just to be profitable.
That's right. So it sends an immediate contraction signal through the industry. When WTI is below 60, a whole chunk of drilling inventory, what they call Tier 2 and Tier 3 acreage, it just becomes uneconomical.
And Wall Street won't let them drill if it doesn't make money.
Not anymore. Capital discipline is the rule now. So we are forecasting an immediate contraction in the U.S. rig count in this first quarter of 2026.
So lower prices mean U.S. production growth basically stalls out, or maybe even declines a little.
It definitely slows the engine of growth. Now, for Canada's oil sands, it's a similar story, but with a different cost structure. The existing projects are cheap to run, maybe $18 to $45 a barrel. They'll keep operating.
But building a new one.
Building a brand new project from scratch, that requires prices to be sustained above $75 or $80 a barrel. So right now, investment in new capacity is completely frozen.
Okay, finally, let's touch on what you call the fragile fringe. These are the oil-dependent nations that don't have those giant sovereign wealth funds to protect them.
And this is where the risk of social instability becomes very real. You look at a country like Iraq. Their fiscal break-even is $75 to $80, and over 90% of their budget comes from oil.
And no big fund to cushion the blow.
Exactly. So that raises the risk of civil unrest if the government can't make payroll or pay for basic services.
Mexico has its own unique problems, right?
A structural nightmare. Their export mix trades at a discount, so they're really only getting $50 or $55 a barrel. And Pemex, the national oil company, is the most indebted in the world. It's no longer a contributor to the state, it's a fiscal liability that constantly needs government bailouts.
And then there's Nigeria.
Nigeria is highly exposed. They have one of the highest break-evens in the world because of a weak tax base, huge fuel subsidies, and high security costs. The IMF has been issuing explicit warnings, basically telling them to rewrite their national budget for the reality of $63 oil.
The pressure on these countries must be immense.
It's acute. They are the first places where financial stress is likely to spill over into actual geopolitical risk.
So to bring it all together, what's the central finding here?
The central finding is that the global market is now firmly installed in that $60 to $80 fiscal death zone. This price band is perfect for efficient producers, but it's simultaneously draining the national reserves of the traditional petrostates.
So what does this mean for markets and investors? We see two immediate implications from this data. First, expect an acceleration of sovereign debt being issued from the Gulf states, especially Saudi Arabia, in the first half of this year to cover those deficits.
And the second point, which is crucial, is the OPEC Plus dilemma. The cartel has effectively lost control. If they try to cut production even deeper to push prices back to $80, they will just surrender more market share to those ultra-competitive Atlantic barrels from Guyana and Brazil.
So their only real strategy is to defend a price floor and just accept the pain.
It seems so. The $63 price we're seeing today is the clearest possible illustration of the triumph of geological and technological efficiency over political necessity. The market is rewarding the lowest cost of production, period.
Here's a final thought to mull over as you think about this. Consider how all this fiscal stress, this instability it creates in places like Iraq or Nigeria or Russia, how that could eventually feed back into supply disruptions. Those disruptions, ironically, could cause sharp price spikes despite all the efficiency in Guyana. The market might be efficient, but the world is still politically messy. And with that, we come to the end of today's deep dive. I hope you liked it, that you learned something new, and that you'll join us for the next one.
Thank you very much, and we will talk again very soon.